Hello traders, how's it going? Today's video is about how to determine bias. This was a question raised by one of my followers, and today I've decided to make a video covering this in depth. We know as traders, whether you're a swing trader, a scalper, or a day trader, you always want to place your focus on anticipating a single candle. Let's take for example you are a day trader. You always want to place your focus on the daily candle to anticipate whether the day is going to be an open high low close day or it's going to be an open low high close day. You always want to know if the day is going to close bearish or it is going to close bullish. Now, in order to anticipate the direction of the daily candle, there are three key components that you need to consider, which are the higher time frame narrative. This will tell you where price is likely to draw to, and you need to know about key level, which will tell you from where price will react in order to draw to your liquidity. And you also need knowledge about phases of price delivery. This is a byproduct of the higher time frame narrative because this tells you what price is currently doing and what it is likely to do next. But in order to understand the higher time frame narrative or phases of price, you need to have a good knowledge on key level. There are a ton of key level out there, but I use mainly three of them. And trust me, this is all that you need. I use a swing point, I use a fair value gap, and I use order blocks. Now, starting with the swing point. There are two types of swing points. We have the C2 closure and we have the C3 closure. Now, what is the difference between these two swing points? Starting with the C2 closure. The C2 closure, this is when we have candle 1 print and candle 2 fail to display below the low of candle 1 closing back within its range. When this happens, then that will give room for candle 3 to expand through the high of candle 2 potentially reaching to the high of candle 1. Now we have the second swing, which is a C3 closure. This is when candle 1 trade, candle 2 display below the low of candle 1, but candle 3 failed to take the low of candle 2. Rather, it display above the opening price of candle 2. Once this happens, which is displaying above the high of candle 2, once this happens, it will give room for candle 4 to trade higher, taking the high of candle 3, potentially reaching for the high of candle 1. So, if price display below the low of candle 1, you cannot anticipate a reversal here until this candle 3 prints out, which will display above candle 2. Then you can anticipate the trade candle 4 that you'll be confident that will trade to the high of candle 3, potentially reaching the high of candle 1. Now let's take a look at our second key level, which is a fair value gap. Now, what is a fair value gap? A fair value gap is a 3-candle pattern where candle 1's high doesn't elapse with the low of candle 3. So we have candle 1, candle 2, and candle 3. But the high of candle 1 does not elapse with the low of candle 3. So there is a gap in between. And we have our last key level, which is an order block. An order block is either a single candle or a series of candles which can trade into a key level followed by an opposing candle closing above its opening price. So here in this example, we have a series of down close candle, which we have candle 1, candle 2 closes bearish, but followed by a bullish candle that closes above the opening price of candle 2. So this becomes an order block. And in this example, in this C3 closure, this candle 2 is also an order block. Why? Because candle 3 closes above the opening price of candle 2. So once this happens, this candle 2 becomes an order block, and now it will give you much confidence to anticipate candle 4 trading through the high of candle 3, potentially reaching for the high of candle 1. Now that we have a good knowledge on key levels, let's take a look at how we can blend the key level with higher time frame narrative. In order to understand narrative, you need to understand the reaction of price from this key level that we have just learned, right? And we know that price cannot reverse without a swing point. Price cannot reverse without a swing point. So in order for price to reverse from a key level, it must form a swing point. It must form one of these swing points in that key level before it can revert. So with that knowledge in mind, we always want to monitor how price react from key levels. Now, if we get the swing point formed in a key level, that swing point become a protected swing. For instance, if price trade into a fair value gap and form a swing point in that fair value gap, as we can see here, this swing point become a protected swing point. We do not want to see price trade back into this low until it has reached a relevant key level, until it has mitigated a relevant key level. For this example, we have a C2, C1, C2, and C3. So this is a C3 closure because why? We have candle 1, which confirms the fair value gap, would form the fair value gap with candle 1. In this example, you can see we have candle 1, candle 2, and candle 3, right? If you want to look at this key level, which is a fair value gap, you have candle 1, candle 2, and candle 3. Now, it forms what? A fair value gap. Now, in order to consider the swing point, we have candle 1 and candle 2, then candle 3. We can see that candle 2 did not close back within the range of candle 1. So we need to wait for candle 3 to close above the high of candle 2. Once this happens, then you can be confident to anticipate candle 4 trading to this key level, which is a swing point, right? So this becomes our draw on liquidity. So you can see we are blending higher time frame narrative with key level, how price react from key level in order to determine our bias of the next candle, right? And we have another example right here. You can see that price trade into this relevant swing and forms a swing point from where? From this relevant swing, which is our key level, right? So we know that a swing point is a key level, as we have just learned in the previous slide. A swing point is a key level. So we have a swing point from a swing point. So this swing point that has formed become a protected swing. We do not want price to return back to that high unless it has mitigated the opposite side key level. So in contrast, price is just moving from one key level to another key level. That is what is happening every single day. It's either moving from internal range liquidity to external range liquidity, or it is moving from external range liquidity into internal range liquidity, or in this example, from external range liquidity to external range liquidity. So price will always move from one key level to another key level, but you need to look for these signatures from that key level. You don't just want price to trade into a key level, but you want to monitor how price reacts when it gets to that key level. And know that we only want to trade expansion candle. You do not want to trade the reversal candle. Let the candle 2 print out, forming the reversal candle, or in this example, since candle 2 did not close back within the range of candle 1, you want to wait for candle 3 to print out. Now, once candle 3 prints out and close above the high of candle 2, then you will trade candle 4, because what? Candle 4 now will expand through the high of candle 3, potentially reaching for this draw on liquidity. And in this example, which is our second type of swing point, we have candle 1 print, then candle 2 engage with the key level, closing back within the range of candle 1. Once candle 2 close back within the range of candle 1, then you can anticipate candle 3 to display below the low of candle 1, potentially reaching for candle 1. And in this example, you can see that candle 3 ripped through the low of candle 2 and it also traded through the low of candle 1. And if candle 3 display below the low of candle 2, what can you anticipate candle 4 to do? To also trade below the low of candle 3, potentially reaching to the nearby key level or draw on liquidity that you have, right? So you're getting what? You're getting your directional bias off of the higher time frame narrative and how price react from a key level. It establish a solid bias. So you always want to trade the expansion candle. You do not want to trade reversal candle. Let the reversal candle prints out, then you look forward to trade the expansion candle. So with this knowledge that we have, let's take a look at some examples on the chart, or potentially looking at what we have been doing in the past episode, where we have been backtesting the GxT model in the Forex market. So I'm going back to that session that we created so you can have a better understanding of what I have been doing all this while. Here we are on our session here. So we have this session already that we have created, and so far we've had 3 episodes, which we took 11 trades, right? So I'm going to go back on that chart to show you how I have been applying that knowledge that you have just learned in order to trade or anticipate where price is likely to draw to. So we started from this week. This is where we started. So I'm going to focus on single pair. Let's pick this GBP USD. This is where we started our backtesting, right? This is a candle we started trading from. So I'm going to put it at weekly open. It can display here. It will only, yeah, let me put it there. So this is a candle that we were anticipating to trade to this low, potentially reaching to this low, right? We opened there this session when we were on this candle. This candle I just printed. And if you haven't watched the three series, I highly advise you go and watch them so you understand what I am explaining here. Now I want to show you how I was able to tell that this candle will be a bearish candle. Now if you take a look at this reaction here, you will see that we had a key level here, which is a fair value gap. We had a fair value gap here. And what can you notice? The reaction of price on that key level, we had C1 and C2. We had a swing point form where from that relevant key level. Now, once I saw that we have a developing swing point from that relevant key level, I was able to anticipate candle 3 to trade to this low here. The reversal candle had already printed. Now I am only aligning myself with expansion. Now our focus was to trade this candle. Now let me drop down on the daily time frame to show you how I also align myself with expansion on the daily time frame within this weekly time frame. So dropping down on the daily time frame, we can see that the day opened on Monday. This is Monday here. We opened and traded higher where into this fair value gap, right? We traded into this fair value gap and also this other block here, right? We had this series of down close candle that CSD the other block. So this becomes an other block right here, right? So what did we do? Monday open, trade into that other block. And what did we do? After we trade into that key level, we formed a reversal candle. I need you to pay close attention. We form a reversal candle from where? From this key level right here, right? So I am aligning myself with the weekly expansion candle. Now, when I drop on the daily time frame, I also want to align myself with an expansion candle. I don't want to trade the reversal candle. Now, once this Monday candle expand higher, then Tuesday prints a reversal candle. Now I am confident to anticipate Wednesday to form an expansion candle to trade lower into this low or potentially reaching for this weekly draw on liquidity that we have here. So whether you are a swing trader, you can apply this knowledge here. What you want to do, you are anticipating this weekly candle to draw to this swing low here. Now you drop down to the daily time frame. Now once you have spotted the daily reaction where candle 1, which is Monday, trade into a key level, then Tuesday reverse, what do you expect Wednesday to do? Wednesday should expand to your draw on liquidity. Now you are aligning the weekly expansion with the daily expansion. Now, assuming that you are a swing trader and you want to take your trade straight away from here, how can you take it? Let me mark this out so you can follow up with me. I do not want anyone to get lost. Add it a little bit. So this is where we are, right? So we are aligning the C2 candle from a key level. We want to trade what now? We want to trade this candle here. We want to trade this candle. We want to trade this candle the expansion candle, which is C3. We know we have C1, C2, which is a reversal candle. Now we are anticipating to trade what? The C3. Now you can drop down on the hourly time frame to look for entry or your entry signatures. Now, how do you confirm that reversal from the key level? It is with a CSD, right? You need price to CSD, the series of up close candle that trade into that key level to form your C2. Then you can look to trade the continuation of candle 3, which is the daily candle, right? So let's say you come on the lower time frame, which is the hourly time frame where you want to execute your trade. You can see we have already a reversal signature here. Then this day open here, which is Wednesday. Wednesday open at what time? It opened here. Then trade where? It traded into this other block here. You can see that it traded into this other block. Then it did what? It formed a swing point. We have candle 1, candle 2. I don't want to confuse you, but take a look. What do we have from a key level, which is this other block here? Or if you don't want to look at that as an other block, then you can look at the swing point. We have a swing point here. You can see that. So we have a swing point here. We trade into that swing point, and what do we form there? We form candle 1, candle 2, then candle 3. So this is our second type of swing point, which is a C3 closure. Candle 2 did not display back within the range of candle 1, but candle 3 display below the low of candle 2. So this is a swing point. You can also now anticipate candle 4 to expand lower. You see how you are aligning expansion candle from the weekly time frame right down to the hourly time frame to trade where? To the same draw, which is your weekly draw on liquidity. Now let's say, for instance, you want to execute this trade from this daily swing point, which is anticipating Wednesday to trade lower. You can just execute this trade on the hourly time frame. Why? Because you already have your reversal signature being confirmed by this CSD here. So you just need a continuation signature, and you had it right here when this candle CSD, this up close candle. So this is a continuation signature. You can go in and take your trade from here, putting your stop loss above the recent swing high, targeting what? Your weekly draw on liquidity. So you are aligning yourself with expansion candle from the weekly time frame, daily to daily time frame. Now you are executing on the hourly time frame. Let's say you don't want to execute this trade on the hourly time frame. You can also take a look at the 4-hour time frame. What can you see on the 4-hour time frame? We have what? We have a C2 closure, right? We have a C2 closure here. You can see that. We have a C2 closure here. Now, as I said, you don't just look for swing points. You want those swing points to form from a relevant key level. Now, is there any relevant key level here? No, we have a fair value gap, but here, we have a fair value gap here. Let me take this out. We have a fair value gap here. So I would want this swing point to form from this fair value gap. But there is something you should understand. We are dealing with 3 pairs, which means if this GBP USD doesn't trade into this fair value gap, Euro USD might trade into the fair value gap, or DXY might trade into that fair value gap, forming what? An XMT. So let's take a look. If we had an SMT, that key level here, was there any SMT with that key level? Taking a look at it, if we had an SMT with the key level, okay, we did not have any SMT with this fair value gap, but we had another fair value gap here. So we were potentially reacting within a key level, but the fair value gap did not print on both assets. So we're going to take a look at it, but on this Euro USD. So this is the key level, right? So we have a fair value gap here. This is a fair value gap. And what can you see in that fair value gap? We have a swing point formed in that fair value gap from a relevant key level. Now, once you have C1 formed, C2 failed to display above the high of candle 1, then closing back within its range and even taking the low of candle 1, you are much confident to anticipate C4 to expand lower, right? So if candle 1 trade into a key level and candle 2 manipulates the high of candle 2 closing back within the range, and in this example even display below the low of candle 1, then you can be confident to anticipate candle 4 or candle 3 to trade lower. Now in this example, since you are trading from, you are using the 4-hour swing point, you can drop down on the 15-minute to trade away from. So this is candle 4 I have marked. I'm going to drop down on the 15-minute to look for what? Continuation signatures to trade away from. We can see that candle 4 open here, trade away into a key level. You can see that into an order block. It traded into an order block, then display below candle 1. We have candle what? We have candle 1, candle 2, candle 3. So this is another our second type of swing point, right? So this is candle 1, candle 2, candle 3. Candle 2 fail to close back within the range. Candle 2 rather display above the high of candle 1 into that key level, which is an order block. But candle 3 failed to take the high of candle 2, rather it displays below the low of candle 2. So we can be confident to anticipate candle 4 to trade lower. You see how you are aligning expansion candle from the weekly time frame, be it the monthly time frame or yearly time frame, right down to the 15-minute time frame. You're just aligning yourself with expansion. Now, we are looking to execute from the 4-hour swing point. Do not forget, we are looking to execute from this 4-hour swing point, right? So I'm going to execute it on the 15-minute. What I just need from the 15-minute is a continuation signature, right? I need a continuation signature, and I got it right here. Once price open, this is a 4-hour candle. He opened at 5, trade into this key level, which is an order block. Then once we CSD that order block, which is closing below the candle that traded into that key level, I can be confident to take a trade, placing my stop above the recent swing high, targeting my draw on liquidity, right? So this is the knowledge I have been using throughout the backtesting session that we have been doing. This is the exact knowledge that I have been using to anticipate the weekly candle or the daily candle or the 4-hour candle or the hourly or 30-minute candle, right? So if you are confusing or struggling with your directional bias on the 15-minute time frame, take a look at the 4-hour time frame and everything will become clear for you. And if you are struggling with directional bias on the 4-hour time frame, take a look at the weekly time frame and everything will become clear to you. You can take a look at the weekly time frame or the daily time frame and everything will become clear to you. And if you are confusing with directional bias on the daily time frame, take a look at the weekly time frame or potentially the monthly time frame, and you will understand what price is doing. So I just want to explain to you how you can determine your bias and how you can navigate from one time frame to another time frame. That's aligning one time frame to the other, seeking what? Expansion candle, seeking to trade only expansion candle. You do not want to engage with reversal candle. No, you only want to trade expansion candle. Now let's take a look at it one more time. One example, you will see that this is a monthly time frame, right? The same concept over and over. You can see we engage with what? This high here. After we engage with the high, what happened? We form a C2. a C2 swing point. We can see candle 1 trade into that high. Candle 2 failed to display above the high of candle 1 closing but within the range. So what can you anticipate candle 3 to do? To trade lower. Now, if candle 3 display below the low of candle 2, what can you anticipate candle 4 to do? To trade lower through the low of candle 3, potentially reaching for the nearest swing point, nearest key level, which is the swing point. Now, once candle 4 have displayed below the low of candle 3, then you can anticipate what? Candle 5 to also display below the low of candle 4, and so on until you get another swing point from a key level. Then you can start targeting the opposite direction. As simple as that. Trading becomes very easy when you simplify it, and once you fully understand what you are doing, how you approach the market, trust me, your losses doesn't count because you know that your concept repeats every single day. So this is it, guys. I hope this helped someone there, or even help you who had doubt with this, with how to determine directional bias. So see you in another one, guys. And just for those of you who haven't subscribed to this channel yet, it is still very small, and trust me, my goal is to grow this channel, and just with your help I can achieve that goal. Do subscribe to this channel, like the videos, and if you have any questions, or you can just leave your comments, whatever it is, I will do my very best